And joining me on the podcast right now is Paul Hill, full-time investor, equity analyst, and hopefully bringing a bit of calm to the storm that's not only the markets. It's quite appropriate, isn't it? Storm Eunice is there, and the markets are also a bit stormy, aren't they?
Yeah, we've been battered left, right, and centre across the weather as well as the actual markets. And I mean, you know, you look at it, it's all sort of corners, isn't it? You've got your monetary tightening. You've got fiscal tightening with sort of taxes going up as well. You've got the yield curve flattening now, which is a bit of a nightmare. I mean, that's really sort of developed over the last 2 weeks. And then just to top it all, you've had obviously Ukraine and Russia sort of tensions escalating. And it seems to be in Putin's best interest to carry that one through and to make it last. So, yeah, I mean, wherever every corner you look at, the market has just been really sort of like under pressure.
Yeah, Putin, what an idiot. What are you doing?
Well, you could either say that or alternatively, he's actually playing an absolute blinder because, you know, I mean, his biggest export is oil and gas. Gas, obviously, to Europe, 40% of it goes into to places like Germany, and they're hugely dependent on it. And the price has rocketed, and likewise with crude as well. So, you know, his exports have made a lot of money, and all he's got basically is just a bit of a wrist slap. He hasn't done any sanctions yet. None of his oligarchs have been sort of like their assets have been sequestrated at all across the world. So he's got off scot-free at the moment, but he's obviously helped his economy hugely and put pressure on NATO. So you could ask to say it's in his interest to carry this through as long as he can, as much as anything. There's no incentive for him to finish it early.
Yeah, but do you know what? It's just the whole, you know, I mean, there's no, you know, ethics there, I know, but when you're sort of
ethics in Russia, you're joking, Justin.
No,
what's that about?
But most reasonable people think when your investment policy or your economy, you know, is balanced on the fact of threatening warfare on a neighboring country, I think it's highly questionable. In fact, I just did a poll on Twitter.
It's highly questionable.
Yeah. Will Russia invade Ukraine? And whenever the guys, I mean, the thing is, it's a bit like China and Russia are the biggest threats, aren't they, to the world? You know, pretty much. And it's laughable that Russia even pretend to have, you know, elections.
There's plenty of other sort of geopolitical.
Yeah, but not with the might. We're not with the might and the power of those two countries. You know, Russia and China. And the fact is, you know, in fact, I just put a Twitter poll out saying, "Will Russia invade Ukraine?" 70% of people say no. There's been a build-up of troops bigger than this, you know, I think back about 10 years. And someone did point out, well, wouldn't he have done it by now? Surely he wouldn't wait for the entire world to watch you, then do it, you know? So it's, I mean, the thing is, I think once this steps down, we saw a little bit of a rally, didn't we? When they said we saw troops pulling back out. I don't know where that report came from, but we may see, you know, a relief rally here because the sell-off in the American markets was all based on that and things around that. But there are several worries here. What do you think the biggest worry? I mean, they sort of overlap, the Putin thing and inflation. What do you think the biggest worry for the markets is?
Oh, absolutely, undoubtedly. It's a flattening yield curve, mate. I mean, Jesus, you've just got to look at most sensible people are thinking that obviously it's a bit of saber rattling that Putin's doing. So that problem will go away in the spring. We're through Omicron. And
in the spring?
Yeah, it will go away because basically he won't have invaded. He won't. I don't know. Well, let's see. It'll go away. Omicron and Russia will have gone pretty soon anyway. So we'll be back to what the economy is. And so you come back to what the single most biggest risk is. It's a flattening yield curve because what that's saying is that we're going to get recession either the back end of 2022, as I've heard it from some of the experts, or even 2023. And because what's happening is that you've got basically higher interest rates, you've got a potential policy mistake, and you know, the markets are saying, well, that's going to actually sink growth and we're still going to get elevated inflation going forward. I mean, yes, we've got energy, which has gone up, and that was transitionary, no doubt about it. Electricity as well should roll off with gas, should roll off in about a year's time. But even with that, there's some strong arguments saying, you know, the whole shift to decarbonisation, net zero, etc., and the aging population in China is going to take away those deflationary impacts that have happened over the last sort of 20 years. And on that basis, we're going to see sort of like 3 or 4% inflation. And that's what the yield curve is saying as much as anything. It's such that it's flattening, and it believes there's a policy mistake, and we've given too much jungle juice into the financial markets too soon. So, yeah, I mean, that's by far and away, for me, for serious investors, the thing to watch. What is the steepness or the flatness of the yield curve? I mean, if you actually look at the UK gilt curve, for instance, at the moment, 2 years the 2 year gilt is higher than the 6 years or the 8 to the 8 years. So you've actually got inversion there, not even flattening. You've got inversion between the 2 and the 8. It then ticks up to 10, and then from about 15 to 30, it's actually inverted again. So, I mean, that is saying bad news for the UK economy. But let's be clear about it. On the optimistic side, we're all going to enjoy foreign holidays. We're hopefully going to go to places like Escape Hunt for you, and to enjoy down the pub and to enjoy. Bar. Yeah, the Balloon Battle Bar, and down the pub, and to go out and to enjoy, because we've all been cooped up, and that's actually happening. That playbook is actually happening. So yeah.
When I was looking at, I think, was it Springboard? I think it was, charting a footfall across, train stations, all that. And they're saying consecutively, week after week, footfall is increasing, in towns and cities, which is very good. The thing is here, I was thinking, is there, I mean, people shouldn't, people sort of worry about recessions and stuff like that. And private investors tend to panic and stuff. But I was thinking, is there a way there's no way we can avoid some kind of growth slowdown? First and foremost,
yes.
Higher inflation pretty much cues higher inflation. People's, psychologically, I've done it. If you look at our own behavior, you start looking at things.
You bought yourself a fancy shirt, though, Justin.
No, I've had this for a couple of years. I've had this for a couple of years. I can tell by the fit. It is certainly tight. It's almost tight in the belt.
If you've had it for 2 years, why did your wife allow you to wear it for 2 years? That's all I say. She have burnt it.
Well, it's a conversation starter, put it that way. But as we've witnessed,
or stop her.
But do you know what? No, but in seriousness, if you look at your own behaviour, when things start to go up, you do start to look at things. Doesn't matter where you are. I mean, I'm not talking about billionaires here, but the normal person there, they start thinking, okay, what can I cut back on? And they start looking at things to cut back on. And so if you do that, some parts of the sectors of the economy is going to suffer, full stop. And then you got piled on top of that, raise interest rates. That's a double whammy, isn't it? Because you've got people already cutting back because of inflation. Then you've got companies cutting back because they're going to pay more on their debt and they're not going to expand so fast. So I don't see how we can slow down in growth. It's a very fine line, isn't it? The central banks have to tread here between overdoing it, because we know there's a lag factor, because inflation is going to affect people's spending habits anyway. And then you got interest rates on top. So yeah, is there a way to slow down? But should private investors panic, sell right now and try and predict the recession or slow down growth? Or should they hold, if they're holding good companies, just hold them?
Well, where'd you go if you decide to sell? That's the issue, is if you decide to hold, cash long term, you're going to lose 4, 5, 6% maybe on inflation in real terms every single year. But you can hold it tactically to redeploy, which is what I'm doing. You go into bonds. I mean, yes, bonds have rallied, the yields have increased, but they're still negative on a real yield basis. And then you've got your credit risk as we go to a tighter. So where'd you go, Justin? I mean, do you go down buying, do you go to your tailor, do you, and buy a new shirt, do you?
Well, yes, look, this is what you want. This is what sunny shirts on a horrible day.
So we come back.
Boring suits like you. Yeah, I know. It's beginning of change. Come on. Next time we do this, I want to see you lift the mood with a nice shirt rather than the stained old jacket.
No, you must be joking. I'm stained and old. So, we come back to the playbook A. So where'd you go? But you stay in equities, essentially.
No, exactly. But you see, we're talking about that now. We've seen the small cap market, micro cap market in the UK, in bear market territory. I've looked at so many charts over the last few weeks of small micro caps, and they're down 30, 40, 50%. So that's, even if you put it in a bank, you're doing better than in equities over the last 6 to 8 months. So that's why people are panicking. But right now, I genuinely think, like we said, I mean, I look at the American indices, I think bear markets in the last 18 months, pretty much on average. But I genuinely think we've been in a bear market in the micro cap, small cap space in the UK since 8, 9 months now. So
I mean, I would go, you could almost say it's gone a bit further than that. It's almost a crash, isn't it? I mean, we've had many stocks have just been. It needs some very.
It's
good
funny
ones.
that, isn't it? You know, it's funny that because everyone's focused. I mean, the stocks that get the attention are the big American tech stocks. You know, they've gone up crazily and doing very well, and they're growing. You know, above 20% top line growth for $1 trillion companies is unheard of. And everyone focuses on that, but yet the liquidity is being sucked out of the smaller cap markets. And so, in my mind, I don't know. There's no evidence behind this, but I genuinely think they'll start to rally quicker and faster because they've been in a heck of a bear market for a long time now. So I don't think now's not the time to be bearish, is it? Now's the time to think, okay, if you've got a bit of cash, you can pick up some good value, good companies at good valuations right now, for longer term.
Do you? I mean, I presume you were investing during the great financial crisis. I certainly was anyway. Okay, well,
it's the third crash I've had now. So .com, I still started around then.
I started in the 90s, but anyway. So just turn your mind back to sort of the 2006, 2007. 2006 was everything was roaring. All the banks were doing great. Mortgages, house prices, everything was just flying to the moon. 2007, you had the FTSE still doing very well. You had commodities and oil stocks absolutely ripping to the upside. And that's when you had oil at $145 up until mid 2008. And then you started getting effectively the downturn in the FTSE. But the actual crash in small caps, the correction, it was basically as big as a drawdown as it started really around spring 2007. So at least 12 months earlier than on the large caps. But when the worst happened in the FTSE, which was March 2009, the small cap had already bottomed out mid 2008 or October 2008 and had started to rally. So you're exactly right here. In fact, I think the playbook is going the same way, i.e. small caps have preempted it, and we've seen the bear market. But round about now, we're going to be bottoming out, and we should start seeing, hopefully, on the small caps. And when there's absolutely fabulous, value out there. I mean, even good stocks. I mean, unless somebody can tell me something is fundamentally wrong, and I just don't believe it because I've tested the products and they're great. I mean, just look at Kate Box's shares. I mean, they're down to like 170 from over £4, and that business is absolutely flying. I just don't understand. They've got plenty of cash. The franchises are doing really well. And as we talked about it, that sort of like bear market report from Maynard Payton from ShareScope last time, there was a storm in the teacup. There was nothing in it, in my view. Nothing that told me anything new anyway. So unless there's a fundamental issue there, which I mean, who knows? But I just don't believe there is because I've spoken to the guys and they seem really good chaps. So, I mean, I would say, even the good stocks have just taken an absolute battering. So you can pick up if you decide to sort of like spread some cash onto a broad selection of stocks, then I'm sure you'll do well over a 3 to 5 year view. Very well, in fact.
Yeah. Well, I've been, I'm glad you've brought up, the great financial crash and how, microcaps, small caps preempt it. I don't know why that happens, but they sort of preempt that. And also as liquidity comes out and they're more sensitive, I assume, and then they fall and they rally faster. They go in faster, come out faster, which is a good thing. And it's odd because I started my investment club when it was really bullish, in the market, February last year in 2021. And people were really into it because the previous year has been excellent, and now it's been the opposite. Since April, March, it's been dreadful. And I keep saying it can't keep being like this. The markets are cyclical. I don't know how. I'm not confident in the time frame, but I'm confident they will rally at some point. You'll see a rush of liquidity come in. I don't know when that's going to happen. It'll preempt. So for example, economists are saying now. I don't know how they know this, but they're saying peak inflation around about 8%. April, and it'll start to taper off.
7% in April. 7 to 8%. Yeah.
But that'll preempt that. That's a good thing. If the data comes through that confirms that, I think markets start to rally before that, and H2 could be good for small microcap stocks. But again, you've got to look at, growth and value, haven't you? I mean, there's a lot of stocks. In fact, we're trying to focus on that in the club on a weekly basis and say, listen, try and get the two parts of that puzzle, growth and value, because if you're just going for good value, it could become better value in the next few months' time, unless it can prove they've got some growth there. Because there are some cracking stocks out there, with decent amount of cash, but they have to prove they've got some growth as well, But yeah, I keep being bullish about macro caps, but it's just the time frame. You don't know when they're going to rally. So yeah,
I think if you don't invest, if you want your money back within 12 months, you shouldn't do it. I mean, that's crazy. Yeah. And typically you should only put money into stocks if you've got a sort of 2 to 5 year view as a minimum, which is what, I have. And I'm happy to hold well over 5 years and just carry on. There's no doubt about it if I like the company. So all I would say is that if you're expecting things to rally quickly, then think again, because they don't. They invariably go against what you would like to happen, no doubt about it. And you can see far more pain in the short term. And the fundamental rules, I mean, I view, sort of like you never buy at the bottom and you never sell at the top. It's fluke if you do. So, you just accept if you're making money in between on an average basis, you're doing very well. And likewise, when I said if you'd buy a broad basket of shares, now you'll do well over 3 to 5 years. There's a good saying for small cap investors: concentration is where you generate wealth. Diversification is where you retain wealth. Yeah, you actually maintain it. So, if you've got depending on what you want to do, if you want to go all in on a couple of stocks, then great, fab. You either make or lose a lot of money. But if you've got sort of like a more long-term time horizon and you're thinking of sort of, investing for your retirement or for your kids' education and this sort of stuff over multi decades, then frankly, get decent diversification across sectors, which is why I always say I like lots and lots and lots of stocks, but I can't load up on certain areas or certain types of same stock all the time, just in case something nuclear happens on that particular sector, because you just get so heavier weighting. And I think there's some great bargains out there. I really do. So
have you pinpointed it? Because I know you had some cash.
Yeah, no, I've got a whole bunch of stuff on my buy list, but I haven't yet sort of pulled the trigger. But I'm hoping to over the next few weeks, months. I'm just taking
one stock or
no, a whole bunch of them. Yeah, no. I mean, if it was just one stock, I'd have bought it. No, I'm looking at a few, but they're all in. The real ones I want are somewhere in tech or somewhere in healthcare or a combination of the two. I want lots of IP, IPR effectively, strong pricing power, and resilience to a higher inflation and a harder economy going forward. So that's what I'm ideally looking for, with good growth and good upside, and I'm prepared to hold for a long time and take the drawdowns if that's the case. So that's ideally the type of shares. But I would say if I wanted some really sort of like deep value stuff, consumer's the place to go. I just already have consumer stocks. I've lost money on Boohoo big time, and I've lost money on Purplebricks as well, both consumer stocks. And I don't want to put any more money into that area because I've already got a weighting, and I think they'll come back, and I'm prepared to hold through it.
Yeah, in fact, every week on the webinar I do in the Share Pickers Club, we look at 2 or 3 stocks ideas that some members pitch, and Purplebricks is one of them this week. And a decent amount of cash. An EV of 3 million or something. It's ridiculous, like it was.
Yeah.
But you need that growth to come through. They realize they had an issue. They're dealing with it, aren't they? But again, you've got to witness get that growth coming through. But very interesting. I mean, and in fact, we went through 3 companies, and the charts were bottom right, pretty much, almost 52-week lows. All of them. There's a lot of stocks around like that at the moment. And like I said, it doesn't last like that. And again, conversely, when markets, the macro is so bearish, that is generally the time to start, dipping your toe into the water, I think, if you've got cash, isn't it? Because all the sellers are pretty much out. And true, time frames, if you desperately need the cash this week or next week, and then, try and hold on because we're at lows. So don't sell. But if you don't need the cash and you're investing for the long term, why sell at the lows? It's the worst time to sell. Anyway, stocks. Let's look at some individual stocks. Paul, what we're looking at? Any news
well, I mean, as I say, don't just look at the small caps. I mean, look at some big caps as well, because there's some value there. I mean, I still own, AstraZeneca. I only bought a half position, but frankly, it's done well. It's moving up to a full position now. And, they came out with their full year results, which were in line with all expectations, which was not massively surprised because so many analysts cover the stock. But the good news they had this week was that they've got another treatment through prostate cancer, which could be another $2 to $3 billion a year, sort of like, drug or therapy for them. So, when you've got that type of portfolio of drugs that can each generate sort of billion plus sales with 99% gross margins. I mean, it's just as a license to print money with huge, patents and IPR behind it with great pricing power. It's a perfect place to be. I mean, when I bought it, a year ago or 6 months ago, when we chatted about it, I said, well, I could hold this for 5, 6, 7 years, and I could see it going to £150. I mean, it's currently around about just south of 90. I bought it about 70, and it pays a decent dividend. It's the biggest company in the UK. Just keep going because it's doing a great job. It's not massively expensive. So I would say, places like that, they come down, then you'd be crazy to not put your money into something like that because it's a real steady eddy. And then I would say there's a couple of updates on sort of other healthcare stocks, more sort of pre-revenue. Well, one of them is anyway, it's Verici. They came out last week saying that they'd completed successfully their analytical validation for their pre and post kidney donor transplant diagnostics. That sets it up not only to be able to you need that validation, the sort of like what that essentially does, and it allows you to then calibrate all the diagnostics, the actual results when it comes through, and obviously allows you to get the sort of like Medicare insurance and healthcare insurance out in the States and stuff. So it's another milestone that they've knocked off, and they hope to have the results for those the confirmatory validation study results at the end of the second quarter, and that could be a big sort of value pivot point for the company. And they've come off as well, and that could be an enormous market. So all things are moving in the right direction.
Yeah,
another one.
Chart there, 75 pence at the high. Was that in November, December? Now
I think they were higher than that, actually. I think they were higher than that.
Oh yeah, scroll back.
Yeah, but that's a high IP, IP.
Oh, sorry,
company.
90 pence. Yeah, 90 pence they hit. After a couple months after IPO, and now at 44, so half that price. Yeah.
Another one is Oncimmune, which is in healthcare, and they do, sort of like they've got this huge immuno biobank, that autoantibody biobank that allows them to help large pharmaceutical companies develop their drugs, and as part of that sort of like discovery process. And they came out with another good contract with them, with a top 5 global pharmaceutical company, and this was to treat hives, to do some this is for their Immuno Insights platform, to help them, to basically develop the best treatment and with biomarkers and stuff like that. So they're absolutely doing the right things, and I think they're coming out with their interims towards the end of this month, they said. So I hope
another one, the half price from high again.
Yeah, well, I mean,
this is the way the market is. Small microcap markets, the way it is. Half price from the highs,
Yeah, and just to give it a bit more on, the maths on that one. They're not pre-revenue, they're commercializing this platform, and got lots of large pharmaceutical and biotech businesses as customers. People like Roche and Genentech are well known, and this could really be a breakthrough year financially for the company, because I think Singers are expecting sort of like 2.2 million of EBITDA on sales of just over 12 million for this financial year, which goes, I think it's the end of April or something like that, so it's fairly soon. And if they do that, then that's the first year they've had of profitability. So a real breakthrough year. And then because they make sort of 80% plus gross margins on that Immuno Insights business, and they've scaled up the capacity after their placing last year, then it means that all drops through to the bottom line. And they've got real pricing power, no doubt about it. And I would say, somebody would buy this for £4. If somebody wanted this proprietary platform, the auto antibody platform, and the shares are what, 150, 140, something like that.
143, yeah.
Yeah. So that one is, but that's when I said which ones are on the my buy list. Both of those are really sort of like there and thereabouts. And another one that I've obviously I've talked about a lot and bought, and is actually my largest position now, just because it's increased so much, is Equals. And they said that they'd done what they've said over the last 2 or 3 years they're investing more in their platform to increase their service portfolio. And they announced last week that they had linked in their UK faster payments platform with the European Scepter Instant Credit and Transfer Schemes, which is again essentially a faster payment. So it means that all their corporate customers, and they're increasingly getting bigger and bigger, can now do instant euro to sterling transactions through bank accounts at the touch of a button. And that's a real help because it's hugely speeds up their working capital. Also, obviously, reduces all of much of the costs for those guys, and it's massively simplification for it as well. So a big tick in the box to Equals there. I mean, it's significant. It massively helps their corporate clients, and of course, obviously, it reduces the cost base and gives them a much better competitive position for Equals as well. So, yeah, I mean, that is just it's going from strength to strength. And
well, yeah, that's the first micro cap or small cap stock we looked at where the chart isn't bottom right. It's
and you can understand, and you
right.
and you can understand that because basically they've been knocking the ball out of the park. And, I mean, when you look at the fundamental value, I mean, I think this is worth well over £1.20. And Judith McKenzie, likewise from Downing, reckons it's that. And she's been trying to buy shares. So, all I would say is that, that's one just to stick with. I mean, I know a lot of people would say, yeah, take some money off the table. But I would say, well, on a big picture basis, this business is doing really, really well. It's got a long runway ahead. It's undervalued still. And there's a potential corporate transaction anyway, because somebody might well buy this one up. So there's no reason to sell this.
Talking about fund managers and stuff like that, and I just clicked on the Trufin page on Vox, and of course I hold Trufin. I've seen you in a video with Ken Wooten. Did he mention them? Has he mentioned Trufin? Because I know he holds them, doesn't he, Ken Wooten?
Yeah, he did. He loved them. Yeah, he loved them. Actually, yeah, you should listen to that, Justin. Yeah, absolutely. I mean, he talked about the on gaming part of the business, and he reckons that on its own is worth the market cap. So you get all the financial stuff for free, all the Satago and all that kind of stuff. Yeah, you should really anybody who's an investor in Trufin. I mean, he put out a really strong investment case for the business, no doubt about it.
Well, I mean, there's several parts of the business. I mean, there's less exciting sides like Virtus and Oxygen. Oxygen is for cancels, all that invoice payments and all that stuff. They are, cash generative pretty much. Now, PlayStack and Satago, the exciting bit. PlayStack is the gaming sort of platform, and Satago, of course, is invoice debt financing. Deal with Lloyd's going through hopefully soon, and like I said, that was delayed from December, but they did say it's a further integration. It's not an issue here. And I spoke to James, the CEO, on the podcast, and I keep saying I remember talking to him before the last deadline, and he didn't sound confident it was going to happen before the deadline. He sounds confident it's going to happen, but he didn't sound confident it's going to happen before the. Now they said early 2022. He sounds quite confident it's going to get done early 2022 with Lloyd's, but also what they're not bigging up the factors because they don't want to detract from Lloyd's and stuff is that they have discussions, quite advanced discussions with other big financial networks, and he said they are big. You would have heard of them. They're household names. And they're big. So Saga is also very exciting and PlayStack. But I think this could be a good year for them. And I don't know if you noticed, one of the big cornerstone investors own 21% of Trufin. Are called the Williamson family. Or Watrium is their investment company. But they founded the Royal Caribbean Cruise Liners. And so the family itself are worth $2 billion. They are multi-generational owners. investors. I mean, they don't, flip stocks. And one of the companies they backed for a while is I don't know if you've heard of them, called CMR Surgical. They've valued 3 billion, record-breaking 425 million financing round, and this is apparently it's the largest ever medtech private fundraising round. But Watrium backed them, and these are the kind of guys they say they back. What they say they like to back. They don't say themselves; they're quite conservative, but they back some unicorns, and they've stuck with Trufin from the start, and they own 21%. So, and in fact, the non-exec director, in fact, the chief investment officer of Watrium, who's director Anders Christian Wilhelmsson, he's just become an NED of Trufin, which is quite nice, and he's held positions at Morgan Stanley and all that stuff. So it's nice to get him on board because he's used to dealing with big companies, and it's nice to have that guidance. But that's a family office with, the family's worth billions, but their investment is amazing. So yeah, and it's one of those quiet companies not many people know of. Within itself, you diversify because it owns 4 different companies, and I quite like it. And I think the parts of that business, like you say, could be worth more the entire market cap easy on their own. So I'm just looking forward to news on that. But cool. Another video actually.
Yeah, another one to look at actually, Justin, next week is on Tuesday when it's released. Is I'm doing an interview on the Monday with Richard Penny of Crux Asset Management.
Yeah.
And one of the stocks he likes, I believe, is XP Factory, which is the escape hunt, isn't it? So I'll be getting a good update on that one. So keep your ears and your eyes peeled on that on Tuesday when that hits the tape.
Yeah, well, do you know what? It's funny. It's very good combination, the escape room thing and the boom battle bar, because escape room serves a certain kind of audience. There are fanatics with escape rooms, but you can't Instagram escape rooms, of course. You can't take pictures of all the secrets and so that. So it's not really Instagrammable, but it's a very good recurring business, and people love it. But boom battle bar, on the other hand, competitive socializing is very Instagrammable, and their Instagram accounts are going gangbusters, and even celebs are doing it and all that stuff. And some of the guys in the Sharepickers Investment Club are checking out just the booking sites. And they're saying they're always quite busy, always busy, hard to get any slots. So it's doing very well. As footfall grows, it'll get very impressive. They've opened the one in owner-operated site in O2, which is a massive one. The next super centre is going to be opened in Oxford Street, should be coming out soon. But it seems like they're doing very good business there. And I said, people are looking at based on the last trading update they did, which was just escape rooms, owner-operated, 5 million. But these, boom battle bars do triple the revenue of the escape rooms, and they're rolling them out at quite a pace. And so I think the next trading update we get will be quite surprising uptick in the revenue here. So, but again, the share price is just treading water going sideways. It's quite frustrating, but I think people don't understand the story yet. But it'll come.
I would, yeah. I mean, those are so we've talked about lots of opportunities which are really good. All I would say is that, on the other side of the coin, watch out for companies that need more money, need more financing, or alternatively have got lots of debt, because we saw that one on Monday with a large 100 million.
That's not Escape Factory, by the way. XP Factory, by the way, they've got plenty of cash, and they're going to be EBITDA positive this year. But who are you saying?
Studio Retail, which is basically more of an online type of retail. They do sort of like homewares and clothes and fashions and stuff like that. £500 million revenue. Had a market cap of roughly around about 100 million. They had a bit of debt, but not massively on an EBITDA basis. Anyway, they wanted a 25 million pound new debt facility to help monetize their stock holding from Christmas, and the banks wouldn't give it to them, and they went into receivership. So exactly immediately. So I would say, which says everything, because it means that the shareholders didn't want to put in their extra money in the pocket. So I would say, when it comes to if you're in a business that needs more money, refinancing, and not in a hot space where they're going to be able to get it, or going to have difficulty getting it, I'd personally say you might want to hold it, because the shares probably are going to be all-time lows. But all I would say is that, when you come to select where to put your money, avoid heavily indebted companies, particularly in this higher interest rate environment and where capital is becoming more scarce, because you might find at the most sort of like emergency point that the business needs the actual funding is not going to be available, or if it is, at really, really painful and distressed levels. So you started to see that trend already play out. So beware, all I would say.
So how much debt did they have? Do you know? So
I think they only had about 40 million. It was less than 1 times EBITDA. in terms of the metrics, but so it wasn't huge. They weren't asking for a massive new facility, and the shareholders and the banks decided not to put any more money into it. So I mean, it was a disaster. I mean, they just went basically suspended the shares at 7:30 on Monday morning. So it just says everything. That says everything, that in this environment where if you haven't got a business model that people really believe, then you're going to be really, really struggling to find new available money. So beware. Yeah,
exactly. Marvelous. Anything else happening? Any other news?
Well, there's plenty other happening, but nothing to further discuss. And hopefully over the next.
I'm just going to this second. We got a trading update from Northbridge.
Has it come out? Has it?
Yeah.
I did say they were going to put something out. Let me just
WhatsApp on. Let me just. Pre-close trading update, notes results, disposal of Tasman operations in Australia and New Zealand, capital markets event, and appointment of director. Group revenue for the year expected to increase to 38.8 million, up from 34 million, with Crestwick division growing significantly by 20% to 29.4 million. Okay, so it's the order book looks very good. They say it's at the record level for Crestwick, so it's looking quite positive there.
Let me just how many this is fired up. Oh yeah, gotcha. Wow, yeah, that's right. Okay, so this is really hot off the press, guys. Yeah, just looking at it now, they're basically saying their debt has fallen to £1 million from 5 million last year, which is great, and that's just from the Crestwick. The Crestwick business, which is the load bank hire and sales business, is absolutely flying. The hires revenue's gone up 34%. As I can see, and the actual sale, and is now a bigger part of the actual Crestwick business than the sales, which is up 7%. Now the big question actually is that when they bring the new capacity expansion on in the Q2, is that when they're going to sell that one out? But they're getting higher margins from the rental because it's about 80% drop through rate, and they're in line. So absolutely brilliant. They've got a record order book, which they say with the outlook for 2022 across all regions, which is excellent, not only in data centers, but also in, they've got data centers outside of Europe. And also, they've got looks like they've got good opportunities in Texas with the new facility there as well. And they've sold the Tasman business, or should we say the one in Australia and New Zealand, for £4 million, which is great, which is about where they thought it would do. So that's not far from net assets. And that means they're going to be in positive cash flow. And so they're going to be effectively, standalone basis. And they've appointed Nicholas Mills, who I believe is probably the
Harwood,
son. It's probably the son of Christopher Mills. And I know I've never spoken to Nicholas, but I understand he's another absolute chip off his father's block and really smart. So exactly the kind of person I'd like on the board. I can't see any negatives there. It really is ticking all boxes, which is absolutely great. And I would expect the shares to react positively on that. So that really just shows that we work in real time, because it's 10 past 10 on Friday morning on the 18th, and we've just got the trading update straight through. But that looks all great to me, and I would say, I have a fair value on the stock previously of roughly round about I think it was just over £2, but I'm thinking I'll be increasing that once I've heard a bit more about it and redone the numbers. But revenue is expected to have increased during a pandemic. I mean, that is great. That is at Crestwick. It really is going strong with, it's gone up by 20%. I mean, that's brilliant growth. That is. Yeah. So,
I think you should celebrate and buy yourself a nice loud shirt.
Well, that's at least, I mean, this is what it's quite interesting. Now, another really smart investor, Paul Scott, I interviewed a couple of weeks ago. He said one of the key things is that where you get a company like Northbridge in a great sector, secular grower, etc., because it's obviously all on the renewable energies. Let's see what the shares do today, because if they don't go up, that can present itself as a great buying opportunity. And the reason is because the value has gone up, but the share price hasn't moved, or may have even gone down. Yeah. And so the value upside is increased. So reading that says to me the shares should go up. But if it doesn't,
Yeah,
then
well, I'm
they're
seeing
more of a
initial-
buying opportunity.
They are. It seems some buyers coming in here. Let's look there. I'll just scroll the chart.
Has it gone up? Has it?
Yeah. It's gone up.
Okay, well, that's not a surprise. But I mean, as I say, I think there's plenty of upside, and I'm absolutely delighted that we've got Harwood on the board, because they will really make sure that they continue to make sure that the business is trading to its full potential. So. And they'll provide massive capital if it ever needs it. If this needs more expansion capital, which I don't think it does now, because it's got £3 million of cash pro forma. If it sells its Tasman, Australia, New Zealand business for 4, and it's only got 1 of debt. I mean, just do the maths, and it's generating cash. So, pro forma, it's absolutely clean as a whistle. So yeah, fabulous. Well, hey, great. Well, that's a good way to finish the conversation, isn't it? I'm absolutely chuffed to bits.
Showing, was it at 5%? I'm sure it's in there. Yes, good.
Nice. I don't know, but yeah, well spotted, Justin. Yeah, that was.
That's the benefit of having the Vox Markets app. You see, just put them on your watch list and you get a notification.
Yeah, well, well done. I'll just say, I mean, particularly well done to the team on that one. With the exec chairman.
I think to top it all off, I'm going to send you this shirt because I know you like it, because you've mentioned it a couple of times. So
if you send
it'll probably fit you. It'll probably fit you actually. It'll fit me.
If you send me that shirt, you'll know where it will go.
Yeah. Next time you'll be wearing it. Yay! Lovely. Thanks, Paul.
Take care.
Speak in a fortnight.
Bye.